Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucy, and some of you know me as Triangle Investor from X. Today, I'm joined by my dear friend and one of the smartest guys out there when it comes to uranium and all related uranium stuff. Mart Wolbert, aka Yellow Bull, welcome to my show.
You're too kind, Lucian. Thank you for having me. It's been a long overdue chat.
Yeah, exactly. I'm sure that a lot of people know who are you, but nevertheless, for the new investors in the space, I would like to ask you to tell us more about yourself and your origin story.
Well, as you mentioned, I am Yellowbull11 on Twitter. I'm also a writer and interviewer at my platform, the Contrarian Codex. And on it, I basically spent all of my day, which we discussed a bit off air, probably 24 hours. Feels like it's not enough in this current market environment, but I spent most of my day on uranium, on macro, and on commodity investing in general. And it's been a very volatile journey, but also a great journey over the past few years. I built a great community. I was able to talk to a lot of great people, such as yourself. And
Thank you.
I think that we are in for a great few years as commodity investors. And that is basically what I spend most of my time on, and hope that I will be able to do this for a few more years.
Exactly, good point, and thank you for the kind words. Like you said, you are a founder of Contrarian Codex. Can you tell me more about the services you provide to your clients and what is the format of that?
So what I provide on the Codex is basically the interviews. So that's what you do as well, with industry experts, with company CEOs, with individual analysts on various parts of the commodity spectrum. And besides that, I also write a biweekly newsletter, so once every 2 weeks. And in it, I go over everything across 40 to 50 or more pages on macro, because whether we like it or not, macro influences all of our investments. And it's important to consider the way that it is shaping up. So is monetary policy going to change? Is there going to be a better regime in place for which is more commodity friendly, for example? So I think that's important to keep an eye out on. I spend a lot of time on it each and every single week. I write a Codex macro roadmap, which has been followed remarkably well over the past year. So that is good to see. It has helped us see when we should take off some risk, when we should put on some risk. And beside that, I spend a lot of time, of course, on uranium, as it is my core business model, where I share everything from the spot market to the long-term market to what's happening on the contracting side to what I'm hearing from industry contacts. And it has been seen as very valuable. So I'm always glad to hear that from subscribers. I have been able to build a great community. So that is great to see. And I also focus on other commodities. So, for example, cannabis. Like August last year, we entered cannabis in late August, ahead of the groundbreaking news with regards to the legislation. So one of the positions is up 150%. Since then, we went bullish on precious metals in January and February. The biggest winner is up 200%, and on average, it's double GDX at about 70-75% returns.
Nice.
Copper has done exceptionally well. The positions are up a lot since we entered. So yeah, I think there are a lot of opportunities out there to take advantage of. And I think that you should be diversified, because if you're only invested in a few companies in just one specific sector, even if it is uranium, where the fundamentals are still the best that I have seen at any part of the market, I think it's important to have that diversity to also capture opportunities elsewhere. And I think that we've done a good job at that on the Codex.
Yeah, agreed, definitely. And I will leave the website, your website, under the description of this interview. Let's move to a Russian topic and Russian uranium imports topic. We have uranium imports officially banned now, and we saw that the equities did not respond directly to that. So do you believe we will have any impact on the spot market and equity prices, or is this already calculated in their prices? What's your take?
Oh, I wouldn't say it's already calculated in, because it's kind of hard to really get the full impact of what this long-awaited import ban will do. But I think it's significant, and it's significant for a few reasons. And one of the most important reasons is that this import ban, it first of all finally gives more incentive, political and monetary, to the West, and in particular the US, because it's a US-Russian import ban, to really start building out a secure nuclear fuel cycle. The West has become far too dependent on the import of Russian fuel because they are such a large part of the global fuel fabrication market throughout the fuel cycle. And I think it's good that the US is now finally focusing on building out that secure domestic supply chain. So this bill, it frees up $2.7 billion in funding to build that secure domestic supply chain. And I think that's good. I think that we should become less dependent. And I think that the West should really, because if you see the amount of reactors we have in the West, and even though we've not been very kind to our nuclear industry over the past decade, I think that we're really making up for that right now. And with all the support that is in place, I already mentioned political and monetary support, but public support is also definitely there. I think that it's important to realize that this is a step that has been long overdue, but it's great to still see it. I think another thing that is very important is that it has also provided some clarity for utilities. So utilities, by and large, they have, because again, as I just mentioned, Russia has been a large part of the global nuclear fuel supply chain for a long time right now. And a lot of these utilities have been dependent, at least in part, sometimes in a very large part, on Russian deliveries. So with this ban now in place, I think that it will really wake them up and be like a smell the coffee moment, which they needed to go to the market and now sign their contracts to make sure that they are secured and they can keep their reactor in operation. Because in the US in particular, and we can get into this later as well, because of all the support that's in place, all these reactors, they now have the security of being able to stay in operation for perhaps 10, 20, 30, 40 years longer than they first expected. And if you have that security for operation, you have to go out there to secure the fuel, because you can't let your multi-billion-dollar energy assets sit idle. The utilities shouldn't accept that. The government shouldn't accept that. The public shouldn't accept that. So they need to secure the fuel in whichever way they can, which of course also is part of the reason why there are these waivers in place, right? Because there are waivers in place up to 2028 for utilities. But I think it's very important for the people to understand that, as is part of the legislation as well, it's said only if there is no alternative source of low enriched uranium available for the continued operation of your nuclear power plant. It says it right there in the legislation, and you better be sure that they're going to enforce this, because if you can't find it anywhere else, sure, you can import uranium because we don't want set multi-billion-dollar assets sitting idle. But I think it's important for people to realize that this legislation, it sets things in motion to finally wean off of Russian supply and to kind of push the utilities to secure their contractors, to also expand their inventories, because the global supply chain for nuclear fuel is not exactly the strongest it has been over the past few decades. And if you have the security supply, you need those inventories and you need those contracts to make sure that you can stay in operation. I think that's important to realize how dependent the US has been on Russian imports, because the US in 2022 imported $830 million worth of these products from Russia, which grew to around, I believe it was $1.2 billion last year, which was mostly due to higher price, but also due to a 20% increase in physical volumes, which I believe kind of came because they saw the writing on the wall and they wanted to secure as much fuel as they could via these contracts. So I think that this is important. I mean, even UXC has picked up on this and saying, okay, we should probably see a 20% price increase. And UXC has been notoriously conservative and utility orientated. So I think that with even them saying, okay, this is significant, we will likely see a upward price response off the back of this legislation. I think that's significant. So it's significant on various parts. I think it's a little bit more nuanced than people make it out to be. And one thing that's very important for investors to realize is that everything in the sector, it moves like an oil tanker turning on the ocean. We have all these catalysts. It takes a long time for them to be properly baked in. Some are already baked in, others are not. And as that happens, and as broader retail capital and institutional capital really recognize the opportunity that is here, I think that all these catalysts, they will then really start to matter. So in short, it was a very long-winded answer. My apology for that.
No, it's a great answer, and you nailed the head. But in your opinion, going forward, could we see a potential retaliation by Russia, which could mean a complete cutoff of supply, a shock that is probably not yet priced in the market?
Oh, we absolutely could. We could see Russia pull out the "you can't fire me, I quit" card and say, okay, oh, you have these waivers in place until 2028. Good for you. We are not going to ship you any uranium, so those waivers are useless. And in December, we saw 10x already warn American customers that the Kremlin might preemptively ban Russian uranium. And now that the ban is actually in place, I think that is a response that we could see. Do I think that it's the most likely scenario?
Mhm.
No, I don't. But do I think that it is possible? Yes, I do. I mean, we've seen Fletcher Newton, who is the president of 10x USA, come out and say, okay, they fully intend to honor all of their contractual commitments in the United States, which I fully believe. They've never missed a delivery, and I don't think that they plan on doing this now. But if we see the Russian government say, okay, no, we do not want you to deliver any more of our fuel to the US, I think that it could cause a shock, as you alluded to. And I think that that chance, again, not my base case scenario, but the fact that it is kind of lingering in the background is something that we should take into account. And also consider this. I've seen a few questions with regards to, okay, but why would they kind of shoot themselves in the foot with regards to banning their own exports? Because don't they want to make more money? Isn't this important for the balance sheet of the government? No, it isn't. It's a rounding error on the Russian economic balance sheet, because I believe last year, no, this was in 2022, I believe around $2 billion came from export value from enriched U-235, plutonium compounds, and alloys, and a few other things related to nuclear fuel fabrication. So the total value of the export was $2 billion. Oil was 133 billion. Petroleum gas was 70.5. Or sorry, 71.5. Coal briquettes were 36.5. Lucian, non-fillet frozen fish was $3.8 billion, almost double what the nuclear fuel exports were in terms of monetary value. That is how much of a rounding error this is. So I think that if they do this, they're not going to think twice about the potential monetary consequence on their balance sheet. It's going to be a political move. And given the bifurcation in the market and the not so kind relationship we're seeing between companies amidst continued geopolitical turmoil, I think that there is a chance that this happens. And again, if it doesn't hurt their balance sheet, it's a political move, and a political move can happen from one day to the other. So yeah, if it happens, it will be a shock, but we'll see how it goes.
Yeah, definitely. Mart, I have a question that I get probably daily, few times a day. In what stage of the uranium bull cycle are we? I mean, my main question is going forward. What is your opinion on two possible paths that this uranium bull market could take? One is more of a parabolic spike, and the other one is more steady upward trajectory. Which one is actually more realistic?
That's a very good question. Actually, two very good questions. I'll start
Yeah,
with the first one. With regards to what stage we're in the bull market. A few years ago, I coined something called the stadium model, which I basically used to visualize what part of the cycle we're in. At that point in 2020, I noted that we just built the stadium. So building the stadium is basically what you can see as laying the foundation of a bull market. Which you need, which is basically just the supply-demand fundamentals, the key core thing that is driving this bull market. Then in 2020 to 2021, I noted that we would likely see all the fans and the players come in, which you can see as, let's call it the tailwinds. Like the additional tailwinds that we've seen. We already had the foundation for the stadium, and now we see nuclear support all throughout the world. We're seeing supply side problems. We're seeing financial entities enter. All these players, everything, like you like football, right? All these great players coming in. Oh, you're Croatian, so Modric, Gavardio, all the great players coming in, which is all the great catalysts that we're seeing right now. And the game has started. The game started in 2021. And now I think we have just seen halftime, and I think that we're ready for the second half. Could we go to penalties? Could we stretch this out? We absolutely could. But as with pretty much every football game, I'm going to stick to football in this stadium analogy because we're both European and it is the most popular sport. So I would say that it's very important to take that into account, that the second half of the game is likely to be the most exciting. A lot of things will be happening, but at some point it is going to end. I think that we could be here for another 3 years. We could only be here for 1 year. It really depends. I'm going to get into that later with regards to the two paths that we could take. But I think one important part of the stadium analogy is that at some point you're going to be in the final minutes and it's going to be a draw, for example, just to continue on the analogy. And it's going to be very exciting and everybody's going to be jumping up around. Everybody's going to be so enthusiastic. It's the greatest game ever. It's going to continue for another 90 minutes and another 90 minutes after that. We're going to have penalties into the sunset. But at that point, you should probably get to your car so you're not stuck in traffic. And with stuck in traffic, I mean that you are stuck holding your profits, because at some point there's going to come a time to sell. Even though nuclear power looks like it has the brightest future ahead of the industry for the coming few decades, this is a cyclical commodity. And at some point, it's going to turn down. At some point, you're going to have to sell, even when the game gets the most exciting. So I think that's definitely something that we need to take into account. As for what path we could take, you already mentioned it a little bit. Path number one is a parabolic spike. I think that is a throw up a coin. Like we're going to reach some ridiculous number that's not going to make any sense. It's going to be 135. It's going to be 185. Is it going to be 231? Is it going to be 314? Is it going to be 500? I do not know. I just know that if we see a parabolic spike, it's not going to make any sense when we get there. It's not going to make any sense on the way up. But we could see, as some industry analysts like to call it, animal spirits take over. And in such a small industry with a cumulative publicly traded market cap of around, I believe today is like 63, 65 billion, maybe it could be a little bit less right now.
Yeah.
A lot of capital flows could really move this market up and down with the amount of financial entities that are entering a relatively tight spot market. We could see the price go absolutely parabolic, like a chaotic price spike, as some have coined it. And I think that's definitely a scenario that has merit. And if it happens, I think it happens over the coming 6 to 12 months. And I think the equities will re-rate aggressively on that as capital starts flowing in. But that brings us to the second path. And I think the second path is a little bit more calm. In the second path, we see a more calm demand side. We see less supply side problems than we perhaps may be expecting, which still my base case scenario, that we see more supply side problems as we have seen so far. And I think in that case, we just go up with the contracting cycle. We get 2, 3, 4 years of contracting. We see a steady upward trajectory for the price of uranium to the mid hundreds, triple digits. I think we definitely reach. Allow the equities some time to re-rate, allow it to really take their place into this bull market. And after that, after contract cycle is over and the game ends, so to speak, to continue on the analogy once again, I think that both of these paths have merit. Let's see, we could even see both. We could see a parabolic price spike, which ends at, pick your number, and then goes back down to say $85 to $110 for a few years to incentivize enough supply to come online. But if we see that parabolic price spike, personally, I have a few indicators, including sentiment that I model myself in the Codex, which has helped us try to price in intermediate tops and bottoms. It has helped call a few bottoms and a few tops, which has certainly helped. It's not a perfect art. You need to take it with a few different metrics, as you need to do with everything.
Yeah, exactly.
But exactly. So it's so that's definitely something to take into account. But I have a few metrics to watch for an exit strategy, and I can tell you right now, spoiler alert, I am not going to stick around after a parabolic spike, because if the price of uranium goes to, call it 200, and it goes back down to 90, the equities are going to get slaughtered. I don't want to be around for that. I want to be in my car reminiscent about the great game I just watched, and then maybe go back for the game. Maybe there's a game in a few weeks' time. I'll be happy to go back then, but I'm happy to to have those nice memories / profits to lock in at that point. So I think both paths have merit. I think I can make an argument for both. I can make multiple arguments for both paths, as I just discussed. So it really depends what we see, and I think we need to be flexible, and I think you need to be very, very clear in what your portfolio strategy is and what your risk tolerance is and the way that you want to play this bull market.
Wise words, my friend, and full of advices for new investors. So pay attention, people, what Mart just said. Let's move to a little bit shorter terms. Uranium equities performance. Who will benefit next? What's your take?
Well, from a historical perspective, in these bull cycles, we should probably see the developers and the exploration companies benefit next, because we've seen the producers, we've seen the larger cap equities benefit, because some of the larger capital that has come in, either directly into the companies or via ETF flows, they have benefited most. So your Negxens, your Denizens, your Chemicals, like they are, exactly. They are at multi-year highs, which for a good reason, because they are the first beneficiaries of a bull market as capital comes in. Now we will probably see, them continue to do well as more institutional capital comes flowing in. But as the story goes out more and more, I think that we will see the smaller caps benefit from more retail capital flows. I have shared this chart on Twitter a few times now, and it shows basically the way that a bull market goes. So you have like the first rally, you have a bear trap sell-off, and then you enter the media phase, and then it goes up from there into euphoria and just a new paradigm. And look at this, and the bull market is going to go on for years and years and years. And I think that we're entering the media phase. We're seeing more institutional interest. I've been speaking to several institutions that are doing their due diligence and asking questions that I would say are showing that they're only starting just now to do their due diligence. So they're trying to learn the basics, which is understandable before you deploy a significant amount of capital. So they are in that process right now. And I think that's important to realize that as this sector gets more attention, you will see, and I love this quote, and I use it in every single interview that I do, price movement will justify the narrative. And as the price goes up, the narrative will be, oh my God, the story is happening, the thesis is playing out, these equities are going to X number, the price of physical uranium is going to X number. And that is probably when you will see the smaller caps outperform as well. I think that one thing that is important to realize is that the relatively high interest rate environment has been pushing down. So if you look at it from a historical perspective, high interest rates have a dampening effect on commodity-related equities, especially the junior, smaller caps that are trading at exchanges that are predominantly denominated in commodity-centric currencies. So the TSX with the Canadian dollar, the ASX with the Australian dollar, and a few other examples. So I think a low rate interest environment will definitely help the equities going forward. But in general, if this follows historical paradigms, actually rather historical precedent, we will see exploration companies and developers, the smaller caps, benefit next over the course of this bull market.
I agree on that. Mart, spot market activities. What's your take on the current activities volumes? What's your comment?
Oh, it's going up a bit again after being knocked down from what was it, like 108. That had its reasons. A few sellers came in. A few Japanese trading houses had something to say about that high price. As they went into month-end, they don't really care about moving the price too much. They just want to get their bonuses, which is honestly understandable. It's a business after all. But what we have seen over the past few months is that spot has bought a little over £1 million over the past few weeks, with spot ticking up again. I believe it's now like into the 90s, 91, 92, something like that. And the spot has bought, I believe it's £1,050,000. So they started on April 23rd. That's when we really started seeing the flywheel effect again with £100,000. The week after that, they followed it up with £500,000 over, I believe it was 4 transactions. Then they bought another £400,000 last week, and then another £50,000 this Monday. So that is definitely securing a lot of pounds. Like they're back at stacking, which is good to see because it like kicks the flywheel back into motion. I believe they now have like $25 million still left in the bank, and they have seen a few times that they've been trading at a premium to net asset value. And I think that has really shown to be a good indicator because in March, I called for the bottom to be in on the 14th of March, which was a day after the bottom, because on the 14th we saw like a reversal. The sentiment indicators flipped green as in, okay, the bottom could be in right now, but we also saw in early March that the net asset value was at, I believe it's a premium at minus 15%, and it's only traded at or below minus 15% for counting that day, 6 days. Over the last 987 days.
Wow.
So it usually, over the past few times, it has always indicated that a bottom was either in or close, and it has once again proven to be true, because right now we're at between that -1% to -5% range, with even a few premium days over the past few weeks as well. And I think that it's important for people to realize that with such a tight spot market, really big buying, it's going to ramp up the price, just like selling is going to ramp up the price. We've even seen a $5 drop on no transactions at all, which should tell you all you need to know about how tight the market is. And in Q1 of this year, we saw 9 to 11 million pounds being traded. And that may seem like a lot, especially when people tell you that, the market's going to move $10 to 200,000 pounds. But 9 to 11 million pounds in one quarter, that is the lowest we have seen since 2016, which marked the bear market low. That is at least what my numbers are telling me. And I think that it is really showing how tight the market is right now, because the price is a lot higher than it was back then. A lot of people that wanted to take profits above $100 per pound, they have taken the profits, which is understandable. If you get in at 30 and you're in an institutional capital group, like, you're going to take that 3x and you're going to invest it in somewhere else. You need to be prudent about your risk management. But yeah, I think that we have a long way to go. And with the spot market being as tight as it is, if we see really big buyers coming in, which I am hearing from contacts that there are several buyers on the sidelines that want a piece of that yellow cake, that they will come in over the coming few months and years, and they will have an impact.
I'm hearing similar stuff, so I have to agree on that. Mart, what about the term market? What are you seeing and hearing over there?
Oh, it's very exciting, because last year we got to, I think, 161.5 million pounds being contracted, and that is kicking in the first replacement rate contracting cycle once again we've seen in a long time in this market. And replacement rate contracting cycles are always paired with a firm upward trajectory for the price of uranium, because we see more and more price discovery as utilities come in for pounds. So term prices right now, according to UxC Trade Tech, are moving between $75 and $85 per pound, but we are already moving beyond that. I'm hearing that some floors with negotiations, they're already moving into that range. I'm hearing that ceilings are in the $110 to $120 range, with even some contracts like the one between CNNC and CNUC having no ceilings at all. They have floors in place, but no ceilings.
Yeah.
So yeah, contracting negotiations are being very robust. We've had a relatively calm start of the year. I think that was partly due to the relative uncertainty with regards to potential Russian uranium import bans. But with that out of the way right now, I think if we see any more shocks, we're going to see a lot more contracting happening. And if we see more replacement rate contracting happening this year, combined with an inventory restocking cycle, we have a long way to go with regards to price discovery, because we got billions of pounds that are still left uncovered over the coming 2 decades, and they will need to be covered one way or another. And one thing that people also need to consider is that flexibility is coming down, and that has historically been a sign that we are in a seller's market right now, which is good for the price of uranium. So all these bells and whistles that utilities have gone into their contracts over the past decade, like those flag options, are coming down to sometimes even 0, but not much more than, say, 3 to 5%, which they used to be like 4 or 5 times that in the bear market, when utilities really needed to please the utilities, saying, okay, you can get this and this and this, and all these terms into your contract to sweeten the deal a little bit. Not anymore. We're firmly entering a seller's market, and with the sellers now at the buttons, I think that means higher prices.
Yeah, and we mentioned millions of pounds of uranium, and we had a transaction from Negxen where they bought a 2.7 million pounds. It's not from the spot market; they bought it from the fund, but it is a notable amount. Would you agree? So, is that a good sign for the overall market? Would you agree on that?
I think it's a good sign. I think they bought it from MMCap. It's a confusing name, by the way, but I'm just going to call them MCap. So MCap, they had 2.7 million pounds. They sold it to Negxen. I think that's good. I think it puts it on the balance sheet of Negxen, and that really, it kind of locks them up, because if MCap was sitting there on 2.7 million pounds, there was a chance that they would start then selling it slowly but surely, putting a little bit of pressure on the spot market, selling it to perhaps other traders,
Yeah.
where it can flow around the spot market then. But right now it's locked up, and Negxen is likely going to use it in negotiations with utilities. So I would wager that those 2.7 million pounds are now going to, quote unquote, uranium heaven, to end users. On the other side of the spectrum, while it is good for the industry that these pounds are now locked up, which is positive. For Negxen, I can see why the market provided a gut punch, and I would experience it as a gut punch as well as a shareholder of the company, because it's all nice and well that you have these pounds on your balance sheet, and yes, we both agree, and all of the listeners will likely agree, that the price of uranium is going to go up. But honestly, a 250 million convertible debenture with a 9% coupon of 5 years with 6% cash pay, that is, I believe that comes down to like $22.5 million in annual cash payments, plus the issuance of shares. And for a pre-revenue company with the G&A structure that they have, that is a huge capital commitment. Yes, the price of those holdings is likely going to go up. And yes, Lucian, we are likely going to see that being useful for them as they use those pounds in contract negotiations, offtake agreements. But like the deal, like this 250 million convertible debenture, it is it could have been done a little bit more efficient. Let's be kind about it. Let's call it that. But you know, it is what it is. I would say it's decent for the overall market. It's positive. And right now, I think it also is, if you take a little bit more of a nuanced view to it, I think it also kind of tells the market that Negxen is not super confident that they're going to get this mine online in the aforementioned time frame of, let's say, 2027, 2028, which was perhaps the case a few years ago. Personally, I don't think we see a single pound being produced before 2030. And if they want to have some room to play with, and if they want to have at least something to point on their balance sheet, like, oh no, we're creating value because the value of our pounds is going up, it certainly drives a narrative. But yeah, I think it could have been done a little bit more efficient.
Yeah, you nailed this one, and that would be the exact my answer if you're interviewing me. So spot on, Mart.
Maybe I
Definitely.
should do that at some point.
Okay, we will arrange that. Mart, with every new forecast of structural supply shortage of uranium, the numbers are bigger and more dramatic. You would agree on that. Who will and how fill the gap? What possible scenarios do we have here?
It's quite scary to realize that Kazatomprom has said that we need 2 more Kazatomproms by 2030. At this rate, with the amount of demand side catalysts we're seeing, we're likely need another Kazatomprom before 2030. Or let's say 2040. So we need a lot more supply, and the existing Kazatomprom can't even properly ramp up. But even if you wave a magic wand and you say, okay, we're going to bring all this supply online, ramp them up to 20% above subsoil use agreement, ramp up chemical, bring on Denison, bring on Negxen, bring back all these brownfield deposits, we are still looking at a deficit over the coming few years, which is very scary if you are in dire need of uranium, which again, like we have, I believe, 1.2 billion pounds in uncontracted volumes that still need to be contracted. I believe 2.1 billion pounds by 2040. So that is still something we need to keep in mind. And what is the solution? More greenfield exploration. There are uranium deposits out there. We just need the capital and expertise to take it out of the ground. but we don't have
Yeah,
that right now.
but why it's so hard to increase primary mine supply? What's your take on that?
Complete lack of intellectual capital, Lucian. Like we've seen so many people retire or leave the sector for greener pastures. And without the right intellectual capital, it is very hard to build a uranium mine. There are so many people that they talk a big game, but they don't have any actual experience with operating, with developing, building, and operating a uranium mine anywhere in the world. So there's definitely something to keep in mind. So I think we will see a lot of those supply side issues continue going forward, especially when you consider that even the best producer in the world, including Kazatomprom, are facing issues. So with that in mind, we need a lot more greenfield exploration. We need a lot more greenfield development. And I think if we get that, we will get there. And a high enough price, Lucian, it incentivizes enough supply to come online, but only if the price is high enough for a long enough period of time. Because more importantly than price, I think uranium needs time. So I think that is something to absolutely keep in mind. But as humans, we are very resourceful. If the price of a certain thing is high enough, we will find replacements. We will find different ways to secure said commodity or anything else. And with regards to uranium, like we will find a different way to extract uranium from certain places. I'm not looking for seawater extraction necessarily, but there are other ways that people might not be thinking about. So I think we can close the gap if the price is high enough for long enough, but people shouldn't be scared about that, because if the price is high enough for long enough, that will be very good for our investments before this cycle even ends. But I wouldn't really get my hopes up about like a massive, like quick supply response. I think like some people have called for, okay, but like we have 2 billion pounds in Sweden in these two deposits. Great, try to extract it. It is shale hosted 0.02% on average uranium. Before you can get that out of the ground commercially and get that into the right super expensive extraction circuits, that is going to take you billions of dollars and years upon years of your time. So again, a supply response at a high enough price for a long enough time, it is coming, it will come. But I think we're some ways away from seeing an adequate enough supply response before we need to start worrying about the thesis.
Yeah. Final question, Mart. You already answered the part of that question, and that is the big money on the sidelines. So when do you expect big money stepping in more aggressively in the uranium equities? And like you said, we can expect the money inflow in the companies on the lower scale, not chemicals, UEC or Negxen, but some explorers or developers. So when do you expect that to happen?
It depends on the speed of the cycle. We already discussed that we have two different paths going forward. If it's path number one, which is the chaotic spikes scenario, we see it sooner. If not, it could take a few more months, maybe a year before we really like it will start dripping up and see like steady upward trajectory with all the volatility that we've become accustomed to over the past few years in this sector. But it depends on the path, and we've already seen some more generalist capital coming in, like Fidelity taking an 8%, because $300 million stake in Paladin. I think we will see more of that going forward. I think it will trickle down to the juniors, but it depends on the cycle. I think we will see it, but again, a rising tide, it will lift all boats, but not all boats are created equally. So if you invest with the notion purely if the extent of your due diligence is the price of uranium goes up and this company has uranium in it, I would recommend doing a little bit more, because not all boats again are created equally. On the Codex, we have a structured portfolio of a few key uranium companies that we follow all the news of on a daily basis. And I also have a sample portfolio on the Codex with 4 risk categories, so 8 companies per risk category, where I say, okay, this is low risk. And if you want to say I add 1 low risk company, but then I want to swing for the fences and I will go with 4 more high risk, high reward companies, then I will get you covered on that as well. But I think it's very important that everybody does their own due diligence and to make sure that they know what they're getting into. It's a very volatile sector. It's relatively liquid. But I think that we have a very good time ahead as the game gets into the second half.
That was Mart Wolbert, aka Yellow Bull. Buddy, thank you very much for this interview. I really, really enjoyed it. And let's catch up sometime soon again. Thank you.
Thank you for having me, Lucien.